While everyone's terrified about the next housing crash, smart investors are quietly building $500 to $1,000 monthly passive income from dividend stocks, and they're not waiting for real estate prices to drop. Here's the counterintuitive truth. Housing downturns are when dividend stocks shine brightest. And I'm going to show you exactly how to build a recession-resistant portfolio that generates cash every single month, regardless of whether your neighborhood's home values are climbing or crashing. I'm Brick and Dollar, and this channel exists at the intersection of real estate and wealth building. If you're torn between renting and buying, or you're terrified of overpaying for a house right now, this video might change everything. Let's start with the math, because this is where it gets interesting. Last week, I got a message from a viewer who just watched their neighbor's The Nest home value drop $80,000 in 8 months. They asked me, should I buy now or wait? The real answer? Don't just pick one strategy. While you're waiting for that perfect housing market moment, dividend stocks are actively working for you. We're talking about companies that have paid shareholders through recessions, depressions, wars, and pandemics. That's not coincidence, it's business model. Here's what most people don't understand. During a housing crash, rental demand increases. People who can't afford to buy suddenly need apartments. And guess what owns massive apartment complexes and rental properties? Real estate investment trusts, or REITs. They're dividend stocks that own the exact properties you're waiting to buy cheaper. So while you're sitting on cash waiting for prices to drop, you could be earning 4 to 8% dividend yields from the companies that own commercial real estate. You're getting paid while you wait. It's the move almost nobody talks about. Let me give you the numbers. If you invested $100,000 into a diversified dividend portfolio yielding 5%, you generate $5,000 in annual passive income. That's roughly $407 every single month, completely passive. You don't fix toilets, you don't screen tenants, you don't deal with evictions. Now, could that same $100,000 buy you a rental property in many markets? Sure, but a rental property with $5,000 annual income would need significant appreciation or additional leverage. During a recession, appreciation stops. During a housing crash, it reverses. The dividend stock pays you anyway. But let's be real, not all dividend stocks survive recessions. That's the critical part. You need to know which sectors actually thrive when the economy tightens, because some industries get obliterated in downturns. Tech stocks? Discretionary retail? Auto manufacturers? These companies slash dividends or eliminate them entirely when recessions hit. But there are 4 sectors that historically hold strong. I call them recession-resistant dividend zones. First, utilities. When people lose jobs, they still need electricity, water, and gas. Utility companies operate under regulated frameworks that guarantee profit margins. They pay dividends through thick and thin. During the 2008 crisis, while everyone's portfolio was getting destroyed, utility dividends kept flowing. Companies like Duke Energy, American Water Works, and NextEra Energy are essentially printing dividend checks from essential services. Second, healthcare and pharmaceuticals. Recessions don't stop people from getting sick. If anything, stress increases healthcare demand. The difference is, people cut discretionary spending. They skip vacations, delay car repairs, but they don't skip prescription refills or doctor visits. Johnson & Johnson, Pfizer, and AbbVie have paid dividends for decades, including through 2008-2009, when other sectors were getting decimated. Third, consumer staples. This is boring stuff. Toilet paper, toothpaste, shampoo, Coca-Cola, Procter & Gamble. During the worst economy, people still buy these things. Dividend yields in this sector typically range from 2% to 4%, and the companies have pricing power that actually increases during inflation. When recessions hit, these stocks often gain value while paying steady dividends. Fourth, real estate investment trusts, REITs. I mentioned this earlier. Most REITs own apartments, warehouses, data centers, or shopping centers. During housing crashes, rental demand surges. And here's the beauty. By law, REITs must distribute 90% of their taxable income to shareholders. Some REITs yield 4 to 6%, meaning your capital is literally forced to pay you. The 2008 housing crisis proved this. While home prices collapsed, apartment vacancies actually decreased. People who couldn't qualify for mortgages needed rentals. REITs that owned apartment complexes maintained dividend payments. So let's build the actual portfolio. I'm going to walk you through a realistic allocation that would generate $500 monthly passive income. This assumes a $120,000 starting investment. For those scaling larger, just multiply the percentages. Allocate 30% to utilities. That's $36,000. A mix of 3 to 4 utility companies gives you geographic and operational diversity. With average yields around 3.5%, this generates $1,206 annually or $105 monthly. Allocate 25% to healthcare, $30,000. Companies like Johnson & Johnson yielding 2.5 to 3% add another $750 to $900 annually or roughly $65 monthly. Allocate 25% to consumer staples, $30,000. Procter & Gamble, Colgate-Palmolive, Kraft Heinz yielding 3 to 4% generate another $900 to $1,200 annually or about $75 to $100 monthly. Allocate 20% to REITs, $24,000. A mix of residential and commercial REITs averaging 4.5 to 5.5% yields generates $1,080 to $320 annually, or roughly $90 to $110 monthly. Total monthly passive income from this allocation, approximately $335 to $420, depending on exact dividend distributions and timing. To hit $500 monthly, you'd need roughly $145,000 to $155,000 deployed. But here's the thing. Dividends compound. Reinvest distributions for 2 years, and that $500 target gets much easier to reach. Now, here's where this gets really interesting for real estate investors. You don't have to choose between dividend stocks and rental properties. The smartest players do both. Imagine this scenario. You're waiting for home prices to drop 15 to 20% in your market. That could take 2 years, maybe 3. During that time, instead of sitting on $200,000 in cash earning 0.5% at the bank, deploy $150,000 into dividend stocks, generating $600 to $700 monthly. Over 2 years, that's $14,400 to $16,800 in pure passive income. Add reinvested dividends, and you're looking at $18,000 to $20,000 total capital growth. Now, when home prices drop, you have $220,000 to $230,000 instead of $200,000. You buy that rental property with more capital, which means better cash flow from day one, or you can buy in a better neighborhood. Meanwhile, you've already proven you can generate passive income. The dividend portfolio keeps paying you while you manage the rental. Most landlords get stressed because they're dependent on tenant income. But if you're already generating $600 monthly from dividends, a $400 monthly net from a rental property is just bonus income. You're not desperate. You make better decisions. Let's look at real history here. During the 2008-2009 housing collapse, here's what actually happened in the dividend stock world. Johnson & Johnson maintained its dividend. Stock fell 25%, but the dividend yield became incredibly attractive. Investors buying at the lows in 2009 locked in 3.5% plus yields on a company that's been paying dividends for 50-plus consecutive years. Procter & Gamble, stock dropped 40% from peak to trough, but dividend kept flowing. The dividend yield went from 2% to over 4% at the low point. Smart investors bought aggressively. Duke Energy, utility stock actually gained value during the crisis because demand for utilities never stopped. Dividend, untouched. Apartment REITs. This is the fascinating one. While single-family home prices crashed, apartment occupancy rates stayed high. REITs that owned apartments actually became more profitable. Dividends held or increased. Compare that to someone who tried to time the bottom, missed it, and didn't buy anything for 3 years. The patient dividend investors who kept buying during the crash have compounded wealth for 15-plus years now. Not because they caught the exact bottom. Nobody does. But because they owned income-producing assets while waiting. Here's my closing framework for you. If you're genuinely uncertain about whether to rent or buy right now, build a dividend income stream first. It's not instead of real estate. It's while you're deciding. Target $500 to $1,000 monthly passive income from dividends. This gives you 1. Actual cash flow you can reinvest into real estate when timing feels right. 2. Proof of concept that you can generate passive income. This builds confidence. 3. A safety net if your rental property strategy doesn't work out perfectly. 4. Peace of mind, knowing you're not sitting idle waiting for a housing crash. The companies that pay dividends through recessions aren't sexy. They're not getting written up in tech blogs, but they're reliable, and reliability compounds into serious wealth. Build this portfolio, reinvest dividends for the first 18 to 24 months. Then deploy capital into real estate from a position of strength, not desperation. That's the move that creates real wealth.